Welcome to the Deep Dive.
Today, we are strapping in for a high-velocity analysis of Elastic NV, ticker ESTC.
Yep, they just released their Q2 fiscal year 2026 earnings after the bell on November 20th.
And our mission today is, well, it's pretty straightforward.
It is. Elastic's management called the quarter outstanding. I mean, you look at the operational performance, the AI wins, it looks great on paper.
But the investor reaction was, let's just say brutal, an immediate, deep skepticism about the future.
So we need to cut through that noise. We're going to synthesize the raw results, which were excellent, and then figure out why the market decided to inflict this severe valuation reset the very next morning.
That disconnect is the entire story here. You know, it wasn't about the last 3 months. It was all about the next 12. We're going to break down the fundamentals, the huge new contract.
Including a massive one with the U.S. government.
Oh, yeah. And then we'll zero in on the exact wording and the guidance that made institutions just slam the sell button and completely change the narrative around this company's growth.
Okay, so let's start with that operational snapshot. The part management was genuinely celebrating. The bottom line was a smash hit.
It really was. Non-GAAP EPS landed at 64 cents.
Which was a solid, 5 or 6 cents higher than the street consensus?
Yeah.
They were looking for 58, maybe 59 cents.
Exactly. A clear beat on margin.
And revenue.
Revenue came in strong, $423 million. That's up 16% year over year, which is pretty much right where analysts expected it to be.
Okay, so in line there.
But the thing that really underscores the quality here is the profitability. Their non-GAAP operating margin was 16.5%. That's $70 million in operating income.
16.5%. That's significant. For anyone listening who tracks these fast-growing cloud software companies, why is a margin like that considered so robust when you're still chasing 16% revenue growth?
It just signals maturity and efficiency. For a company still in growth mode, that kind of margin tells you their land and expand model is working really, really well.
So they're not just burning tons of cash to get that next dollar's revenue.
Not at all. It validates their pricing power, the platform's stickiness. I mean, these are truly excellent fundamentals.
So if the fundamentals were so fantastic, why was the market reaction so punitive? Why did it signal such extreme caution? I mean, was this just market volatility, or did they see something you're missing?
It wasn't just volatility, no. This was a profound valuation reset, and it was driven by big money.
How could you tell?
The trading volume. On November 21st, the day after the release, it was huge, nearly 9 million shares.
Wow. And what's the normal daily average?
It's less than half that. So when you see volume more than double, that tells you institutions are aggressively getting out or repositioning.
So they were reacting to the future, not the past.
Exactly. The market had priced in this huge reacceleration because of all the Jina AI hype. The guidance just, well, it didn't deliver on that incredibly high bar.
Okay, so let's dig into the quality of that sales engine then.
Yeah.
The sales-led subscription revenue. That's the core of the business, right?
Right, and it grew 18% year over year to $349 million. A really strong base.
But the real growth engine is the cloud.
Always. Elastic Cloud is still the fastest growing part of the business. It hit $206 million, which is a 22% jump year over year.
And as more customers move from self-managed to cloud, that's just better for Elastic. Higher margins, stickier revenue.
Precisely.
Okay, so what about forward visibility? How much revenue do they have locked in for the near future?
That's where we look at CRPO, or current remaining performance obligation.
Right. Just to clarify for everyone, CRPO is the contracted guaranteed revenue they'll recognize over the next 12 months.
Yep. And that figure grew 17% to $971 million.
Almost $1 billion in guaranteed future revenue. That provides a really solid floor for them.
It does. It confirms the health of their entire contract pipeline.
And financially, it seems like the ship is incredibly well run. $27 million in operating cash flow, $26 million in adjusted free cash flow. And they're sitting on nearly $1.4 billion in liquidity.
That liquidity is strategic dry powder. It lets them do M&A, like the Jina AI deal we'll get to, without stressing the balance sheet. And it just signals stability, which is what big enterprise customers want to see before they sign multi-year deals.
Speaking of those big enterprise deals, the commitment strength this quarter was pretty impressive.
It was. They now have over 1,600 customers spending more than $100,000 in ACV annual contract value.
And that's up from, what, 1420 a year ago?
Yeah, a huge jump. It's a clear signal that big companies are consolidating on their platform.
And when we talk big deals, you have to look at TCV, right? The total contract value, over multiple years.
Exactly. They secured over 30 commitments worth more than $1 million in ACV. But here's the kicker. 5 of those were for more than $10 million in TCV, and 2 were over $20 million.
20 million TCV, those are foundational company-defining contracts.
They absolutely are.
So if they're locking in these massive deals, why isn't that showing up as a more dramatic acceleration in their expansion revenue?
Yeah.
What was the read on the net expansion rate?
The NER, yeah. It held stable at about 112%.
Which is healthy, but not shooting the lights out.
It's healthy, yeah. But here is the fascinating little nugget management dropped. They said Gen AI workloads specifically contributed about 5 percentage points of growth to that NER.
Wait, 5 points just from AI consumption?
5 full percentage points.
So that's concrete proof. It's not just marketing hype. It's customers actually using more compute, more storage because of AI.
Precisely. It validates their whole thesis that Elasticsearch is the essential data layer for agile architectures. When you build Gen AI agents, you need a vector database, and that means higher consumption on their cloud.
Let's talk about those massive wins you mentioned, specifically that big security deal and the federal government contract.
Right, so the big wins really show them as a platform consolidator. They landed an 8-figure deal with a major global chemical manufacturer for elastic security.
And that was a displacement.
A total displacement. They're replacing a bunch of fragmented legacy tools to become the central XDR platform.
Okay, and the government deal. $26 million with CISA, the U.S. Federal Cybersecurity Agency. That's a huge stamp of approval.
It's enormous.
But government contracts are notoriously slow to ramp.
Right.
How fast does that $26 million actually hit the revenue line?
Yeah.
Could that be part of why guidance wasn't raised more aggressively?
That is an excellent and very necessary point of skepticism. These huge TCV deals, especially with the feds, they're multi-year commitments. So the CISA deal, where they're basically providing a unified security platform for civilian agencies, it's a huge validation.
But the revenue recognition is slow.
It's paced out over many, many quarters, so it gives them that long-term visibility, but it doesn't give them that rapid quarterly jump the market was demanding.
And all these wins tie directly into their product innovation, right?
Yeah.
Their whole strategy around context engineering for AI.
That's their strategic moat. They're trying to be the intelligence layer that sits between a company's private data and the big, large language models.
So they're not just a search engine anymore. They're the engine that grounds AI in facts.
That's the goal. And they highlighted a few key products in Q2 that are all designed to do just that.
Okay, give us the rundown. What were the big launches?
So, 4 key things to remember. First is Agent Builder. It's a platform for companies to quickly build their own specialized AI agents on top of their own private data.
Like an internal AI system that actually knows what it's talking about.
Exactly. Second is Streams, which is basically an AI agent for observability. It simplifies log analysis so your engineers spend less time digging and more time fixing.
And what about the infrastructure to handle all this new vector search demand?
That's points 3 and 4. They launched the Elastic Inference service, which is basically GPU inference as a service on their cloud.
Making it easy to consume all that GPU power you need for vector search.
Right. And then, maybe my favorite new name for a product, they introduced Disk BBQ.
Disk BBQ. Okay. How does that change the economics for a customer? Is this just a small tweak or is it a game changer?
It's an economic game changer, especially at scale. See, traditional vector search needs a ton of really expensive fast memory. It's a huge cost.
Right.
By making a disk-friendly algorithm, they're slashing the operational costs of storing and retrieving all those vectors. It lets customers build massive indexes without breaking the bank on memory. That's a huge differentiator.
And we can't forget the acquisition of Jina AI.
That M&A move just reinforces the whole strategy. They closed the deal for Jina AI, which brings in top-tier talent and tech for multimodal and multilingual embeddings.
So handling images, different languages, things like that.
Exactly. It just deepens their competitive moat in search AI against, both the big cloud providers and the open source guys.
Okay. We've established that the operations, the customer wins, the product innovation, all of it was exceptional.
It was.
But now we have to shift to the guidance, because this is where the market's disappointment really came from.
This is the whole story. To get the disappointment, you have to first understand the expectation. Leading into this call, the market had valued Elastic for a reacceleration, back to high teens, maybe even 20% year-over-year growth.
All fueled by that Gen AI enthusiasm.
All of it.
And what did management actually deliver?
So they did raise the full year guidance. Revenue is now guided to about $1.72 billion at the high end, and non-GAAP EPS up to 246.
Okay, so they raised.
They raised, yes, but that top-line revenue guidance only implies about 16% year-over-year growth.
So they raised the bar to where they were already performing, not to where the market hoped they would go.
Exactly. And that gap, that space between the 16% they guided to and the 20% the market had priced in, that's the single reason for the stock's correction.
It was all about expectations. So what specific headwinds did they cite? What made them so cautious for the back half of the year?
There was one really clear, tangible one. The U.S. government shut down in October. Management confirmed it delayed about 5% of their Q2 renewals into Q3. And specifically, these were the self-managed term licenses.
Why those licenses in particular? Why were they more vulnerable than, say, cloud consumption deals?
That's a great question. Cloud consumption is just. It's continuous. But term licenses, especially for federal agencies, they require all these manual renewal steps, approvals, budget releases.
Stuff that just grinds to a halt during a shutdown.
Completely. Now, they said the deals are expected to close in Q3, but that timing shift, it just artificially depressed the Q2 growth and made the forward guidance look a little soft.
And zooming out, this has really hurt the stock. It's down, what, nearly 26% over the last year, while the S&P is up 11%.
That's a huge underperformance, and it reflects this broader trend of multiple compression in software. Investors are just scrutinizing growth durability, and the market has put ESTC firmly in the show me category now.
They need to prove that 16% growth isn't the new normal.
Right. They need to prove it's a temporary dip, not a structural deceleration.
Which leads us directly to capital allocation. The best signal of what management truly believes. What did they do with their cash this quarter?
They put their money where their conviction is. They were actively buying back stock.
Under their $500 million program.
Yep. In Q2, they deployed about $114 million to buy 1.4 million shares. But here is the key piece of data for us, for the listener. It's the average price they paid.
Okay.
Approximately $84.45 per share.
Wait a minute. Management, using the company's own cash, was buying stock at an average of $84.45.
That's what they did.
And the market is now trading it down in the low 70s. That's a massive signal.
It is. Management is screaming that they believe the stock is severely undervalued. They're looking at the long-term cash generation, the AI deals compounding, and they're buying the dip. Hard.
So the setup heading into Q3 is a business guided to mid-teens growth, but with a strong 112% ER, new AI tailwinds, and huge sticky deals, while the market has just hammered the valuation.
Exactly. And Q3 is even artificially sweetened by those delayed government deals, which should give them an immediate tailwind.
Okay, we have synthesized the earnings, analyzed the sentiment, and dissected the setup. Now it's time for our segment where we pitch an outrageous but plausible trade idea based on all this. And remember, this is purely for analysis, for intellectual curiosity. It is not financial advice.
My thesis is centered entirely on that valuation gap. The one driven by what I think is an institutional overreaction. ESTC is oversold because of the guidance reset. It's trading near $70.
A massive discount to that $84.45 buyback price.
A massive discount. You have management saying the stock is worth more than $84 and the market is saying $70.
Oh.
That creates a really interesting asymmetric opportunity.
It's a powerful gap. So how would you structure a trade to exploit that?
Given the strong underlying factors, that Jina AI tailwind, adding 5 points to NER, and management's conviction with that aggressive buyback, the trade is a leveraged long position. You're trying to capture a rapid mean reversion.
So options.
You could structure this using out-of-the-money call options, specifically expiring in January.
For January.
Because it gives you enough time for the Q3 results to come out and correct this growth narrative. It allows time for those delayed government contracts to officially close and get recognized.
And the target for the trade is that institutional buy-in price.
The target is $84.45. The whole thesis is that strong Q3 execution, helped by those catch-up deals, will de-risk the story much faster than the market expects. It's a high-conviction bet that you should trust management's valuation over the market's current panic.
A bet on a rapid correction toward fair value.
To wrap this all up, the Q2 print really does support the long-term bull case for Elastic. They're a scaled search AI platform. They're winning massive strategic deals like that CISA commitment, and the AI momentum is real. It's translating directly into revenue.
But the market has set a lower bar for now.
The market has definitively set a lower growth bar for the near term, and that's created this fascinating divergence between fundamentals and valuation.
Which brings us to our final question for you, the listener. Considering the scale of those $20 million TCV deals, the increasing quality of that 16.5% operating margin, and the high-value AI strategy they're executing, how long can the market really afford to ignore that fundamental momentum before this valuation reset transforms into a significant, undeniable opportunity?
Thank you for joining us for this deep dive into Elastic's Q2 FY26 results.